A non-controversial opening statement: our tax system is ridiculously and massively complicated. Well, we all know that, but it's something you really only come to properly appreciate when you have to navigate it in detail. And that with tax comes for some or most of us once a year around now, in the run up to the tax payment deadline on 31st of January. If you're, well, to my mind anyway, mad enough to want to complete your own online tax return, you'll know how easy it is to get bogged down or take wrong turnings and end up having to spend half a day Googling or, last resort, phoning HMRC for help. I have to say that when, as I often am, I'm asked for guidance, I have to hold my hands up and say that I've always firmly delegated this sort of stuff to an accountant. It's pain I'm very happy to pay someone else to bear for me. However, I have decided to go back to school and take the next level of exams, which will eventually, I hope, and who knows, make me a chartered financial advisor. Well, I've asked the other advisors in the team to do it, so I thought, New Year's resolution, I should join the party. Anyway, the first exam coming up later this year, after, they say, at least 150 hours of study, is on tax, about which we talk to clients all the time. When we do, though, we focus on the bits that are most relevant to what we do and what we advise on: investments, pensions, and so on. But when you look in more detail at what has to, or well, at least potentially has to, go into an income tax calculation, for instance, it really is an eye-opener, or some might say an eye-closer. Let me spout a bit of revision at you, all from memory, of course, not scripted. First step: add up all sources of income, gross earnings from employment, self-employment and pensions, rental income, savings income, dividends, chargeable gains on life insurance policies. Deduct gross pension and payroll giving contributions and qualifying loans. That gives you adjusted net income, which tells you how much tax allowance you have. Then extend the tax thresholds with personal pension and gift aid payments, take off allowances from each part of income, earnings, savings, dividends, take off tax reducers such as marriage allowance, take off tax already deducted at source. You get my drift. Or not, as the case may be. My questions: why and how? Well, you can see what's happened over the years is that what started many, many years ago as, well, I'm guessing here, a relatively simple system has been tinkered with multiple times by multiple governments and chancellors. Each time, rather than making big changes, they've slotted their changes into what has gone before in different ways. So there are 3 types of payments into different styles of pensions, all treated differently. There are tax reducers, tax band extenders, tax allowances, types of income. Believe it or not, U-turning is not a new thing in government. So some of the reliefs, deductions and so on were doubtless added in to get around stuff that it was decided was unfair, or might lose votes, take your choice. The on the surface obvious answer is just to sweep an awful lot of this stuff away and simplify the whole darn thing. One tax allowance, all sources of incoming money treated the same, you know where you stand, but it will never happen. It'll be a while before we get on to capital gains and inheritance tax in our studies, but the latter, inheritance tax, is a great example of change with no change. Maggie Thatcher's Conservatives in the 1980s pledged to abolish what was then called the much disliked capital transfer tax. They did, but the first line of the Act of Parliament effectively said that the tax formerly known as capital transfer tax will now be known as inheritance tax. And there we have it. Plus ça change, plus c'est la même chose, or in the words of Pete Townsend, here comes the new boss, same as the old boss.